No attendance yet. Um, the governments do not need to get involved. After the Great Depression started, all the classical economic thinkers advised their governments don't get involved. That's nothing. That has nothing to do with you. Your job is not to get involved and save the economy. Let the markets go back to equilibrium. Let them clear, and then let them come back, and we will have a recovery, and we'll be fine. There was this one guy in London who kept saying that, but you're wrong. Your government needs to do something. And everyone was like, no, communist, be quiet. We're not going to get involved. You're a communist. Stop talking. All of that. And it just kept getting worse and worse and worse. And this one guy in England, he kept saying, you guys, you got to do something. This is not like what you read in your books. This is not going to come back to equilibrium. You have to do something. Again, every single economist was saying, no, it's not the job of the government to get involved. And they had some serious, valid points here as well. But the reality was that instead of actually entering a recovery, things kept getting worse and worse and worse. People were suddenly starving, and like it started to get ugly. Some weird political movements started to grow in Europe, threat of war, then breakdown of society. Everybody started to fear. In that moment, some politicians started to say, okay, maybe we should listen to this English guy. Listen to what he has to say. What do you have to say, Mr. Englishman? And what is your name? Well, his name is John Maynard Keynes. Now, what does he has to say? He was saying that, all that long-term equilibrium that we're always being promised, in the long run, we're all going to be dead. Long run will never happen. It's the short run that happens. It's the short run that matters. The government's role is to get involved with the short run. The government needs to fix the short run. That's why there is a government. If there is no need for a government, then we won't have a government now. The reason that we have a government is to fix the short run, is to make sure that these short run fluctuations are under control. This gave birth to Keynesian thinking. In after the like Romer model, the neoclassical model was a response to the neoclassical economics of the 80s by Margaret Thatcher and Ronald Reagan, former British Prime Minister and former US presidents. They were saying, okay, you know what? Now it's time to go back to the old classical thinking, to minimize the role of governments. Remember, I told you that the classical thinkers, they had some really valid points in telling their governments to stay back and don't get involved. They were saying that every action by the government was heavily influenced by the lobbying of powerful groups. And if you get involved now, trying to fix this, like the US government in 1930s, President Roosevelt, they got involved by a policy, a set of policies, which was called the Green, not the Green, the New Deal, which right now we're talking about a New Deal, which is the Green New Deal. But in that time, the New Deal was the manifestation of Keynesian thinking, that the US government started to get active and it started to try to fix the economic fluctuations in the short run. We're not caring about the long run, forget about the long run. As John Maynard Keynes said, in the long run, we're all going to be dead. Let's focus on the short run. Let's try to fix the short run. So they believe that this involvement of government will only advance the interests of a certain powerful who can indirectly control government's policy. For example, this is one of the many valid arguments that if you get involved, even if you want to fix things, you want to do good, but because you're indirectly being controlled by the powerful, whereas who said it? Frederick Hayek, I think he said it, a very famous critic of Keynesian economy. He was saying that the government has always been working with the rich and the powerful throughout history. And this idea that the government's job is to regulate the stock market, for example, how the government is going to regulate it? According to the desires of those who are to be regulated, because they're the ones who are indirectly influencing the government. They have political power, they have a lot of money, they pay for politicians' campaigns, and like they donate to all these politicians. Therefore, they're indirectly influencing politics. So when a government tries to regulate, for example, the stock market, in reality, the government is only going to regulate the strong, huge financial firms the way they want to be regulated, because they're the ones who are controlling the government. That was their idea. And in the 1980s, it was a return to that idea. Let's not get involved. Economic fluctuations happen. We can only make things worse. Let's not touch it. This was the understanding that we're no longer trying to create the perfect society by playing with the saving rate. If you remember, like in the Solow model or the Romo model, trying to incentivize saving. That's none of your business. Just don't get involved. Or by trying to move labor from production to technology. None of your business. Sit down, let the society think for themselves. Let them decide for themselves. This is the like the backdrop of what caused the return of classical thinking and therefore the neoclassical model or the business cycle model. Wow, that was quite a speech I gave. Yep, Arthur Benz and Wesley Mitchell defined business cycles as fluctuations in aggregate economic activity in which many economic activities expand and contract together in a recurring but not a periodic fashion. Not a periodic fashion, it means that there is not like something like a seasonal. There is no strict order or like predictability associated with this happening. Economic activity typically follows a wavy line over time with 4 phases: trough, then business cycle expansion, which is called the boom, then peak, and after that, a recession. Recession, this is the bad part. The boom is when the economy is growing and growing and growing. The peak is the moment before a recession, before we fall. In other words, draw on the board. Economic growth has three different phases, three main phases. This is time. This is GDP per capita, let's say. You have periods of expansion. Then there is a recession. This is the peak. Expansion, like growth, like 4% economic growth every year. Then there is a recession. It's a sharp drop. And then there is a recovery. That's also another way to show this to you. So, for example, right now, the US economy was growing at 2%, like in 2019, 2%, almost 3%. And then we hit a peak, which was the moment before COVID. COVID and the subsequent lockdowns crashed the economy. If you remember, like at the beginning, you couldn't find toilet paper. Oh my God, those were some times that I will never forget. Just stayed home, didn't do anything. The economy crashed. And now we're in a recovery. Now the businesses are opening up, the economy is getting back on track, and now we have like a 6% growth rate. Very fast, sharp increase. This is the recovery part. You have trough, business cycle expansion, booms. Then there is a peak before the fall, and business cycle contraction, which is a recession. In a recession, economic activity crashes. Business cycle model doesn't try to create the perfect society by arriving at the long run steady state or the long run balanced growth path. No, it just tries to explain things how it is, and tries to help us predict it so that we can be prepared. This is important. Another view of the business cycle is to break aggregate output into long run trends. Potential output, YP, and the short run deviations from trend, output gaps. Is the short run output, like the economy's trend is like this? Are we here? Do we have a let's say this is the long run trend. And this is the real. Let's call this Y bar. Why not? The difference between this point and this point is the short run deviation. YP. This is the trend. This is like how this economy is doing, how it's been doing for the last 30, 40 years. This is the deviation from that trend. Are we experiencing it and output which is unexpectedly larger than trend? Then you could expect going down back to the trend. Are we experiencing output which is lower than the trend line? Then you should expect going up again. This is the view of business cycle. Ah, yes, this is here. Much nicer than mine. You can see in this area, this part, at point T, the economy is experiencing a contraction. It's falling. Output is economic activity is going down over time. So we're experiencing a contraction. The economy is getting this it's getting smaller. After point T, you see the slope of your activity curve. It's going back up. It was a negative during the contraction. The slope is negative. Now it became positive. Now you're seeing an expansion in economic activity. Economic activity is going up, up, and up. And this line, which represents the average behavior of the economy, is the trend line. And the gap between the trend line and what's really happening is your output gap. So at this point, we have a trough. Then the economy starts expanding, expanding. Now at point P, there is a peak before it goes back, goes down again, which is a contraction. These are the 4 business cycles. Your peak, then contraction, then trough, then expansion, then another peak. It's just a constant roller coaster. The economy is a constant roller coaster. We're not trying to preserve it. We're not trying to mess with it. We're not trying to like create the perfect society like the king of the world, which was in the Solow model or the Romo model. I try to influence these people's saving rates so that we can have the ideal world. No, I'm not going to do that here. I'm just trying to use these deviations from trend so that I can predict the next recession and prepare myself. As a business person, I can make a lot of money if I can predict the next recession. As a government, I can prevent a lot of damage if I can prevent if I can predict correctly the next recession. Recessions usually begin with lengthy periods of falling real GDP, like in 1930s. Constant economic contraction was going down and down and down. But there are also exceptions. In the 2000, for example, the 2001 recession, GDP never fell more than 1 quarter in a row, but it was still a recession. In the most recent recession, GDP fell in 2008, even though the National Bureau of Economic Research dates the onset of this recession as December 2007. So even though recession was already beginning in 2007, GDP only fell in 2008. Before GDP started to fall, we were seeing signs of economic crash. This is a good table. Let's see. You can see that you have a trough. Let's start something that we can understand. And 2001, for example. In November 2001, you have a trough. Then the economy starts expanding, expanding. And then in 2007, in December, you will have a peak and then followed by a contraction all the way into 2009. Many economic activities, they move together over the business cycle. They respond to this business cycle. Are we in an expansion? If the economy is expanding, then you can expect unemployment to. What would happen to unemployment when the economy is expanding really quickly, or just expanding? What would happen to unemployment? Common sense.
Go down.
Go down. Yes. What would happen to inflation? That's a tough one. All of these variables, they respond to business cycle. Co-movement of economic variables is either pro-cyclical, which means that it will move directly in the same direction as the business cycle, counter-cyclical, which means that it moves the opposite direction, or acyclical. It means that it doesn't respond to the behavior, the business cycle. Pro-cyclical moves in the same direction. The variable moves up during expansions when business cycle curve is moving up, and down when the business cycle is going down. Counter-cyclical, which is the unemployment you just answered, is when it behaves in the opposite fashion. A variable moves down during expansion, so unemployment goes down. When economic activity is going up, it's counter-cyclical. And acyclical is basically, I don't know, like the taste of my coffee. It has nothing to do with business cycle. Variable with ups and downs that does not coincide with those of the business cycle. Excuse me. Now, timing relative to the business cycle, this is also very important. It can help you position yourself. Leading variable, it reaches a peak or trough before the turning points of a business cycle. So basically, if we're talking about the leading pro-cyclical variable, if business cycle is like this will be your trend. This leading variable will be like this. This helps you to predict the next recession. For example, it could be the interest rate paid for bonds. When companies started to feel that things are about to get bad, they're going to need a lot of capital. Or the difference between short-term and long-term bonds. These could be all, like we'll talk about later, in more detail later. This happens before. And it's a good tool that would help us to predict the next recession. A lagging variable is the opposite. It happens after. So if you're seeing, for example, an expansion, Therefore, we can expect this to happen later. A coincident variable, it reaches a peak or trough at the same time of a business cycle. At the same time. So it moves basically exactly the same way. Let's say unemployment could be like this. Of course, it's a counter-cyclical, but its timing is the exact same. So it would be something like this. Just the opposite of the business cycle. At peak, unemployment would be the lowest. When economic activity is going down, unemployment starts going up. And then this, as you can see. So coincident variables, they reach a peak, reach a peak or trough at the same time. The Conference Board combines 10 leading variables into an index of leading indicators that economists use to forecast changes in the economy. There are reasons to question macroeconomics in the news, leading economic indicators. There are reasons to question the predictive power of the Conference Board, which is like a well, it's a board. They have these different variables that would help to raise the alarm if there's going to be another recession happening. There are reasons to question this, the predictive power of the Conference Board's monthly index in forecasting the business cycle. The Conference Board regularly revises the index when more accurate data become available. Conference Board changes components of the index over time to improve the index's historical record. And the index's performance using real-time data at the time is far less accurate than that using a revised data leading variable. Let's look at these variables. Most important one, real GDP. Real GDP is basically the same as economic activity. It's a broad measure of aggregate economic activity, so that it sometimes serves as a proxy for the business cycle. It is the basics. It is basically the business cycle. You look at it and you can see what's happening. If the GDP is expanding, if the real GDP is going up, therefore you're in an expansion period. If it's going down, therefore you're in a contraction period. And of course, as we talked about in 2008, this one didn't quite work because what do we call it? The recession already began a couple of months earlier before GDP could respond. But in all usual situations, the real GDP is a proxy for the business. Real consumer spending and investment. These are both pro-cyclical and coincident, but investment is more volatile. So consumer spending or consumption, it's more reliable. Why? Because you always need to consume. Consumption, it's a must. You can never not consume anything, but you can always say, okay, let's not save this year, or let's not invest this year. We'll do it next year. You can never say, let me not eat this month or this week. Yeah, the economic activity is expected to go down, therefore I will stop eating for the next week. You can't do that. You need to consume. Even if the economy is going up or going down, you still need to consume. How much you will consume, it depends on the situation. If you feel, oh my God, these are good times, the companies are closing down, people are losing their jobs, therefore, I won't be buying myself all those new fancy stuff. My consumption would go down. That's exactly pro-cyclical and coincident with economic activity. If I see people are losing their jobs and economic activity is going down, I would lower my consumption. On the other hand, if I see everybody's becoming richer and people are being hired and economic expansion is keeps happening and happening and happening, therefore I tell myself, these are good times. I can afford to probably go on that vacation I always wanted. I can afford to spend some money on my own consumption. So real consumer spending, it's a very strong variable. Unemployment, as you just answered, it's counter-cyclical. It moves in the opposite direction. Inflation rate is pro-cyclical and lagging the business cycle. So inflation rate moves in the same direction, but it's lagging the business cycle. It happens after the peak, for example, has happened. After, lagging, after, leading, before, coincident at the same time. You can see real GDP grows, 1960s, all the way to 2013. Like in 2008, there was a recession, boom, there is a drop in real GDP growth. Consumer spending and investment in 2008, Great Recession, it went down. In 2000, and what is this? This is investment growth. Of course, investment is also more responsive. You see, consumption is much more inelastic because you still need to consume. So even though you respond to changes in economic activity, you only respond when it comes to like the luxuries or things that aren't really necessary. You still have to buy food, you still have to buy clothes, you still have to pay for transportation, even if there is an economic recession going on. But investment is not as much inelastic. It's very responsive. If I see people are losing their jobs and times are bad, I'm not going to start a new business. Well, why shouldn't like who does that? There is no need to start and open a new business when every other business is losing customers. People are not being hired, therefore they won't have enough money to pay me. For example, I want to open a restaurant immediately after I saw on TV that we're going to have COVID lockdowns. Why would I do that? If I open a restaurant, no one's going to come and eat in my place. I will lose money. Investment, much more responsive to business cycles. Unemployment rate, again, it's counter-cyclical. In 2008, economic activity went down, unemployment went up. Inflation, pro-cyclical, 2008, activity went down, therefore inflation went down. This is why negative inflation, it may look good on paper, things are getting cheaper. Who doesn't want cheaper stuff? But in reality, negative inflation is a bad thing. You see, in 2008, negative inflation. At one point during this period, the government actually made interest rate negative. I'm pretty sure this happened in Japan. Interest rates became negative. So basically, governments were telling people, like banks, just borrow money and return less later. So I'm literally giving you free money. Just take this free money and go, so that economic activity could come back again. Then this is not something you want to see. This is like a really scary situation to someone. When banks are giving you free money, there you go, sir, there you go, madam, enjoy this free money. This is pretty scary. Financial variables such as stock and bond prices are pro-cyclical, huge note here, and tend to be leading the business cycle. This is why when you turn on the news, they always are saying Dow grew by 10 points and NASDAQ grew by 5 points. It represents the stock and bond prices. They always tell you what's going to happen later. Why is that? It's pro-cyclical and leading. Why is that? Because all those smart people who are trying to short and long stock prices and trying to buy and sell stocks, they have been in this business for a long time. And if there is something that would make them sound an alarm, they would know it. And they would start selling stocks. Therefore, supply would go up, price would go down. If you have like tons of Apple stocks and you are expecting a huge recession, you'll try to immediately sell them. In fact, in 2006, in Israel, a general, he knew about some military activities going to happen. And this general, he had lots of stocks. He started to sell them before the military operation starts, so that he wouldn't lose that much money. And he was punished really heavily for that, because that was illegal for him to do. I think it also happened for a few politicians. I'm not sure, because it's like political. Everybody's accusing the other one of doing this. I'm not sure. But that's in like the Israeli example happened. This shows you that something is about to go bad, go wrong. And these folks who are at the stock market, they're one of the best ones to look at, because they have been doing this for a long time. They have experience, they have skills, they have knowledge. They know what's about to happen. Such as the stocks and bonds are pro-cyclical and tend to lead. They're a really good indicator to predict the next business cycle. But there is, as I told you, there's a huge wait a moment here. It didn't happen during the COVID crisis. During the COVID crisis, the exact opposite of this happened, which I don't know why. I need, like, I'm not a finance guy. I just saw it. After COVID started, the economy was just diving, like it was like these cartoons of, yeah, something is diving like this. And at the same time, stock prices kept going up and up and up. It was very, very strange. In fact, there was an article on Wall Street Journal which said the economy and stock prices, they just completely stopped working together. Pram, go ahead.
I was gonna say that wasn't it I mean, it's isn't also because it's a leading indicator. It's a leading indicator. That's why isn't isn't it because it's a leading indicator that could also be why it was going up? Because
Yeah, they were expecting this to
yeah, they
happen,
were expecting no, they were expecting like
like
the economy to come back.
that was an explanation. Let me just
I
open.
also think because I did the stock market, I was kind of, I think everybody tends to do this in their youth, that they just kind of jump on the stock market and then they lose a bunch of money and then they get out. But I know I was like trying to follow a lot of the data and stuff, and it seemed like I think the actual tech companies they were the ones basically kind of creating a lot of that upsurge because they were experiencing higher growth. And so
That's actually a very good explanation. Yes, at the same like in that period, I was actually studying the whole those fake companies by these tech corporations. And yes, that's a good explanation. Let me just, I will post this. This is a very good article, and it's a video as well. The stock market is ignoring the economy. Here's why. Stocks are booming while companies shred millions of workers from payrolls. Wall Street Journal explains why the stock market is going in its own way. And yeah, what you're saying is actually makes sense. Yeah, that's a very good explanation. I never thought about that in more detail.
yeah. Well, also the other thing is like if you think about it, at least in microecon, like we learned that if and I'm sure this happens in macro as well, like if you have small term kind of like if you're not making money in the short term, like you're making at your marginal cost or slightly above it, but you're not making your like profit, including like fixed costs, then what you do is you determine, okay, do I make money in like the long term? And so that's maybe why the prices were surging as well, is because people were thinking like, I'm gonna get in like kind of on the ground floor and maybe make a quick buck. Because you saw a lot of volatility, at least I saw a lot of volatility in prices.
Yeah,
Um,
but you see, a volatility, we have something which is called the expected value. The
yeah,
volatility doesn't change anything because on average, it's the same if it's going up and going down. So it doesn't
yeah,
change anything. And consider the fact that most people are risk averse. Now, I'm not like a financial expert. I'm looking at it purely from an economic perspective. And when we talk about people who are risk averse, volatility actually reduces the expected benefits of engaging in a market. If you don't
yeah,
like risks, for example, I don't like risks. I don't like to gamble on my house, and like I want stability. I want to be sure that I will have a roof over my head. I won't end up homeless. So
you
yeah.
could ask Wall Street bets.
Yeah.
They might be the exception.
Yeah,
I was
that's
never part of that anyway.
I will post this video on your Moodle so that you can watch it. And yeah, I just needed to tell you that COVID, the whole thing in COVID is like a really weird recession. Now, next one, the interest rate paid on short-term US government bonds, knowing, in other words, treasury bills, they're both pro-cyclical and they're lagging. So they happen after. Why is that? Why it's pro-cyclical and also lagging? Very interesting. So it's basically whenever economic activity goes up, you can expect that interest rates on short-term treasury bills or government bonds to go up after a while. Why? Use a common sense response. This would happen, like these kind of questions may appear on your exam. What do you think? You have an interest rate paid on bonds, which has a direct relation to economic activity, but with a lag. So let me draw this here. Let's say economic activity is going up. Short-term real interest rate for government bonds will also go up, but with a lag. It has something to do with the investment and saving market. Remember, saving investment market? When economic activity goes up, people are more incentivized to invest, correct? Correct? Excuse me?
Could you say the question again? Sorry.
Yeah, when economic activity goes up, people are more incentivized to invest more.
Yeah.
Therefore, investment curve or demand curve for saving for funds would shift to the right.
Oh, right.
This would cause an increase in the interest rate. This is why, after a while, you see this happening. In government bonds, because people will be demanding more money so that they want to start a new business, the interest rate on those government bonds would also go up. So if the government also wants to borrow money, it has to pay a higher interest rate. Yep. On the exam, you'll be seeing these kind of questions, and I need you to have this analytic mind. That's why the first few chapters were very important, especially those shifters of saving and investment. This is why it's so important that you would be able to analyze what would happen to interest rate, what would happen to saving, what would happen to investment when something changes in the business cycle. The spread or the difference in interest rate between long-term and short-term government bonds, leading and pro-cyclical, it's a good predictor of recessions. It can tell you if things are about to get bad or things are about to turn for better. The spread between interest rates on corporate bonds and government bonds is counter-cyclical, as companies are more likely to run out of money in recessions, and thus they will scramble, they would compete with each other to pay more, to pay a higher interest, to be able to borrow money, to be able to survive. This is why in managerial thinking, many say that during times of recessions and hardship, you don't need to grow your company. You just need to try to survive. If you can survive in times of hardship, after recessions are over and expansions begin, then you can expand. This is why companies try to compete with each other to borrow money, to be able to survive this really tough situation. Stock prices, all the way. In 2008, Wall Street crashed, stock prices fell, and it kept going up again. Interest rates on US Treasury bills, as you can see, credit spreads and spreads between difference between long-term and short-term interest rates for government bonds. 2008, Always, if you want to analyze these charts, curves, always look at 2008. That's the easiest, at least for me, because it's such an obvious, huge change in the business cycle. The great, it's in the name, the Great Recession. 2008 again, corporate and government bonds, interest rate, credit spreads, and difference between long and short-term bonds. You can see that the difference went up tremendously in the long, because the long-term interest rates remained the same, but short-term bonds interest rates crashed. Therefore, check this again. Yeah. Go ahead, Prem.
Do you think the fact that there's been like basically 0% interest rates, do you think that's had, I've heard like a lot of, I guess I've read a lot of places that it seems like the 0% interest rates may be having kind of an unduly effect on the economy, just because like I know the bond market's basically kind of been dead because interest rates are so low, but could you maybe explain if it's kind of like a bad thing for them to be zero for so long, or if it's not such a bad thing?
When interest rate is zero, that basically means the costs, the price of money. Interest rate is the price of money. Like, how I want to borrow money from you. Hi, Prem, can I borrow $100? The interest rate I'm offering is the price I'm offering to borrow your money. When interest rate is zero, this basically means that price of borrowing money is zero. Therefore, why would anybody lend money to others? If the price is zero, why would anybody work for free? It's because the opportunity cost is negative. Money is losing its value and there is nothing to do. So therefore, 0% interest rate is a bad thing. 0% interest rate, very, very bad thing. Negative interest rate, even worse. Basically, this means that there is no expectation of profits. If there was, I wouldn't give my money to you for free. I would start a new company on my own. Why should I give my money to you? And then for free, the reason I charge you interest rates is because it's the opportunity cost of my money. The interest rate is the expected profits of the easiest job out there, for example, easiest form of investment. The what was the like in accounting, interest rate always represents the expected profits of the most basic form of investment. For example, if I buy, I don't know, if I buy a hot dog stand just across the street, the expected profits, if I expect 5% interest rate on that hot dog stand, that would be the interest rate. When interest rate is zero, it basically means I'm expecting no profits, and that's a bad thing. Some can win in the situations. If you have this brilliant idea, you can use this brilliant idea to make money in times of recessions and pay no interest rates. Good for you. But usually, if you don't have that $1 million idea, you're going to lose money.
Yeah, so lower interest rates usually means like higher consumption, right?
Not higher consumption. It means lower economic activity.
Oh, lower
Consumption, actually consumption moves in the same direction with investment. When people are buying cars and going on vacations, that means good economic activity. So you would pay good higher like interest rates.
Yeah, yeah, because I know at least my family, like during 2008, we bought a house. We bought a house during the recession, so I was thinking like, I don't know, because they lower the interest rates, maybe it's like you can kind of get lower costs on getting the money
And
back.
like the housing market was a special kind of market in 2008. In
Mhm.
2008, the housing market was the market that crashed. So
Yeah, yeah, that was
supply
another one.
very high. Supply was very high. And when supplies were very high, buying a house was a good idea. I mean, the supply was like high, demand was low, people were losing their jobs. So yeah, it's a different, like we're talking about the aggregate terms, not the
Yeah,
specific markets, like housing market or all these special different specific markets, different set of rules.
okay, that makes sense.
Now, as financial markets throughout the world have become more integrated, the financial crisis in the United States during the fall of 2008 led to a global financial crisis and subsequently simultaneous economic contractions all over the world. It's basically a domino effect because every market in the world is now connected thanks to open trade and all these global markets that we have today. For example, something is like this part is made in Korea, then the battery is made in China, then the whole thing is assembled in Mexico. And the United States, the biggest economy in the world, is the #1 consumer market in the world and also the #1 producer of technology in the world. Therefore, if something goes wrong here, it will spread all over the world. It's basically a domino effect. It led to a global financial crisis. In 2008, when Wall Street crashed, there's like a famous story that the head of the Federal Reserve went to the president and said, if we don't do something in the next 48 hours, the US economy will collapse. And then in the next 96 hours, the world economy will collapse. The world as we know it will end. You will see a completely different world next week. And he was right. Like many people think that bailouts were just some kind of super arbitrary thing that the governments did, and they probably had their friends in the corporations talking to them, and then they paid them a lot of money. But the reality, well, that's also, I'm not going to rule that out. I'm a very suspicious person when it comes to politicians. But the reality is that the situation was so bad that the government just gave this all those billions and billions of dollars to these financial corporations to keep them from crashing and going bankrupt, and therefore keep the domino effect to spread all across the economy and subsequently all over the world. Yep. So that was why it was so scary, like in 2008, because especially 1 minute, because especially when you consider that the United States, it's a super big, strong, and resilient economy. The United States is like Dwayne the Rock Johnson. It's huge and strong. If you hit Dwayne the Rock Johnson in the stomach, he probably can take it. But what if you hit someone who's like very old, like many countries, very old, or very young, like many economies? Will they be able to sustain the blow? No. what makes it really bad is that when there is an economic disaster happening in the United States, the Americans can stomach it much better than other countries, much because they have more resilience. And this is what makes the whole business cycle more important. Go ahead, Prem, you had a question.
Yeah, I'm sorry to keep raising my hand, but the I was gonna ask, is that basically kind of what, like, I know they had TARP. TARP was supposed to be for all those companies. Is it basically to prevent like a liquidity crisis? I know that's kind of why they were buying the Fed was buying paper during the coronavirus, right? They were buying basically mortgage-backed securities to prevent a security crisis or a liquidity crisis.
I don't know about that. I never like we have to wait a few more years before like documentaries are being published and everything.
Yeah,
And I haven't been following all the financial stuff.
yeah. No, I mean that's because like I was kind of worried whenever like the whole what's it called, the whole GameStop thing happened, because like I know they were taking down a bunch of the hedge funds and stuff, and I think like one of the things that kind of I was thinking is like if they start taking down these hedge funds and stuff, the hedge funds have securities and other companies as well. If they have to default on those, then you could actually like have some kind of bigger issue. You know, thankfully it didn't kind of spiral out into something crazy. But you know, I was just wondering like if maybe that was the reason behind it.
No, I don't know. This is not my area of research. I just followed the news, and I was very happy with the outcome. I really like to see those gamers organizing. I enjoyed watching that. That was fun to watch, but I didn't follow it as an expert. Like I don't have any opinion on that. So this is a very good chart here. You can see changes in the United States economy and then changes in similar developed economies like United Kingdom, Australia, and Canada. Let's focus on United Kingdom. In 2008, US economy crashed. United Kingdom's economy crashed even worse. In, let's say, 2000, US economy crashed. UK economy in 2001, this part here, UK's economy crashed again. And basically you can see that because of the nature of globalized economy, the fate of every country is now connected to each other. Especially the United States are like bigger economies, those large open economies back in the earlier chapters, if you remember. Pre-World War I, United States was emerging as a global economic power. The interwar period with the Great Depression and the Roaring 20s, they ended up really bad. And banks could not pay off depositors and other creditors and thus went out of business. That triggered the Great Depression with an unemployment rate as high as 25%. After World War II, high growth, low inflation, and mild recessions between 45 to 73, followed by a period of great inflation in the 1970s, the double-digit inflation rates and the federal funds rates. So double-digit inflation rates in the 1970s changed the game. In response to that, we then had the Great Moderation. Also, one of the things that motivated the whole return of the classical thinking was this great inflation. That the governments actually didn't do well trying to create the perfect society and the utopias they always promise. So there was a huge backlash. The Great Moderation period after 1984, this is Ronald Reagan's and Margaret Thatcher's time. And 2007, era of stability, low volatility of real GDP and inflation. And of course, the Great Recession, which again, some believe that we still haven't recovered from the Great Recession. And then COVID happened, so it was a crisis over a crisis. And like economically, we recovered from 2008 pretty quickly, but to pay off all the government's debt that was accumulated during the crisis, that wasn't done. And then another crisis happened. So governments actually right now, for the first time, the US government, I think its debts is more than 100% of the GDP, which is really, really troubling. It would tie their hands to enacting new policies and to taking on new challenges for decades to come. So 10 more. Business cycles in the United States, a long-term perspective. And this is the GDP growth rate. Yeah, I have to analyze these charts one by one. Let's do that tomorrow. Let's stop here, this part, and then tomorrow we'll finish chapter 8, and I will also give you your next set of homeworks tomorrow. I will grade your current homework 1s and your next set of homeworks. For your midterm 2, I'm thinking about next Monday and chapters 6, 7, 8, which are the macro models, the 3 chapters of the macro models. What do you think? Does Monday look good?
Sounds good to me.
Me
Yeah.
too.
So again, if you have any problems on Monday, don't worry, I'm not gonna fail you because you can't like do it. We'll just send me an email or talk to me after class and we'll figure it out. Anyway, okay.
Is the test going to be the same format as last time, or?
That depends. Like again, your homeworks are going to be the same format, but the tests, it depends on the material we covered. Sometimes I feel like, for example, in your first midterm, I needed you to be able to get dirty, find me the profits, taking derivatives. I didn't want you to give me a final answer. That wasn't good enough. I wanted you to be able to write down the profits equation to be able to analyze as a business thinker what's going to happen. I'm going to fire these many people, even if you don't have the correct numbers, as long as you have the correct mindset, this profit maximizing mindset approach to the problem, you'll get most points.
Yeah, no, the reason why I asked is I was just wondering, like, I know last time it was like a PDF. We just had 24 hours to solve it. So that's kind of the format I was asking. Like, is it gonna be the same as that, or we last time we had 24 hours to.
Yeah. You'll most definitely will again have that.
Okay, all right, that works. Thank you.
Okay, if there's any questions, I can stay and answer. If not, I'm gonna let you go and see you tomorrow. Tomorrow we'll finish chapter 8. Also, please watch the second part of chapter 7. And tomorrow I will also, after we finish chapter 8, I will do a quick review of the second part of chapter 7. If there is any question, I will answer that. And that's
that video that you showed us earlier, is that going to be on the Moodle as well?
Yeah, I'll post it on the Moodle just
Okay.
for you to watch. Just some kind of a nice thing for you to.
Okay, thank you.
Thanks.
Yep, take care.
Thank you.
Thank you.
I did want to ask, did you do attendance today? Because I had to step out and use the
No,
restroom.
no attendance today.
All right, perfect. Thank you so much.
Professor, I want to ask, when is the second middle exam?
Second midterm, Monday, next Monday.
Oh, sure. Thanks.
Yeah, I'll let you know.
Okay. Thank you.
You're welcome. See you tomorrow.
Wait, Monday is on Monday the 26th?